Well, traders remain mixed on the Fed's path forward, as we're talking about here, with nearly 60% still anticipating a rate cut in September. Our very own Jennifer Schomburger spoke with Boston Fed President Susan Collins in an exclusive interview on Tuesday. Susan Collins stressing the importance of not overreacting amid volatile data.
I think what we've seen in the data, and again, consistent with what I heard on the ground today, is things are very volatile. You get some welcome news and then they're challenging news. And so I think it's really important not to overreact to what has been encouraging. I think the data that we have seen recently in terms of CPI, in terms of the producer prices, is consistent with an economy that in an orderly way is becoming better aligned.
For more on this, we are joined by Jake Manoukian, JPMorgan's U.S. Head of Investment Strategy. Jake, thank you so much for joining us in studio. We really appreciate it. And for joining the Billie Eilish listening party earlier, too. But I want to join the Neel Kashkari listening party with you for a second. He was speaking this morning, a little bit less fun, perhaps, not for us. But he said that it could take a year or two to get down to 2% inflation. Do you agree?
It could, but I think that argument is a little bit less relevant for investors. I think the fact of the matter is the global rate cutting cycle is already well underway. We track 37 central banks, 20 of them are already cutting rates. The Fed's going to join the party probably at some point this year. We're 90 days away from the September Fed meeting. Traders are pricing in a 67% chance that that's the first cut. And I think that's what investors need to focus on.
What if we don't see the first cut at that point?
Well, then we'll kick the can to December, but it doesn't change the global backdrop that central banks are in easing mode. And Kashkari's been on the kind of hawkish end of the spectrum. It seems like the core of the committee, and Jerome Powell especially, is very much aligned on this idea that they don't need to get to that 2% target to start cutting. Maybe they want to be there on a 3-month annualized run rate. But I don't think they need, core PCE to be at 2% to start cutting rates.
It's interesting, though, when you talk about the global rate cutting cycle, you have the Swiss National Bank kind of kicking off that domino effect, right? Mm-hmm. One cut then followed by another. We're not seeing that same path forward for every central bank, though. Not all rate cutting cycles are going to be equal, right?
And I think that's a big difference between the rate hiking cycle that we saw, which was very coordinated and very aligned.
Sure.
Whereas this easing cycle is going to be a little bit more staggered. To us, that means there's probably a little bit more volatility in currency markets, maybe a little bit more volatility in FX and kind of cross-currency fixed income. But as long as central banks broadly are pointing in the same direction, it seems like the direction of travel is clear in terms of the support that gives for risk assets.
I mean, the Bank of Canada would also mention, how dare we forget about the cuts that they put out there
really good point.
Ahead of the others. But anyway, one of the huge things that we're trying to figure out from an investment strategy perspective, if you're an investor waking up this morning, this holiday abbreviated trading week, perhaps there's low volume that you're going to see, but you're still trying to chart your next portfolio positioning. If we do head towards a wave of cuts, what is the biggest thing that you should be thinking about?
Yeah, I think the first thing to think about is to be very skeptical of cash. I mean, what we're seeing on our platform is our clients have around 30% of their portfolios in cash. That's up from an average of 25%, when interest rates are at zero. There's still a tremendous amount of cash that's on the sidelines that's been enjoying these kind of 5% plus treasury bill rates that are in real terms, 2.5% after you adjust for inflation. So that's the best that picture's looked in a very long time. We've been in a zero and negative real interest rate policy for a while. So cash hasn't been trash. It's obviously underperformed the S&P 500, but I think it's felt like a safety blanket. And that safety blanket is going to get much less attractive when rate cuts start to come. And when you add a layer of the idea that the Federal Reserve is going to be cutting rates most likely outside of a recession, the underperformance to both stocks and bonds is pretty meaningful when we look back at other soft landings. So that's the key view for us if you're waking up this morning.
Sticking with the bonds portion of that, I am curious whether or not we're starting to see kind of a peak in bonds, given that we've got 90 days until that next potential cut from the Federal Reserve. If that is to be true, have investors missed the opportunity to dive into treasuries, particularly at the front end of the curve?
They probably missed the peak in yields, right? I think, the 10-year in our view, in our base case, probably isn't going back to 5%. But that doesn't mean there's not opportunities in fixed income, especially for U.S. taxpayers. I mean, municipal bond yields have underperformed Treasury yields over the last month, and they've finally widened out to levels that are a little bit more attractive on an after-tax basis. That's one of the key areas where we're focused, and that is even more important if you're in a high tax state like the tri-state area, California, et cetera. And then when you think forward to the election, which might be a topic of conversation later, people are worried about the deficit. They're worried about the national debt. We're less focused on what's actually going to happen in this election and more focused on the long-term direction of travel, which is likely to higher tax rates for individuals. So that makes tax efficiency in your portfolio all the more important, and municipal bonds are kind of the anchor for that allocation.
And also, since you mentioned it, in a year of global elections where more than half the world's population expected to participate in one form or another, this could also have a major impact in terms of foreign policy and the international business relations, where that is actually could potentially be a tax on top of what we're already accustomed to here. How do you see that changing in this kind of broader, the broader outlook that you were mentioning a moment ago?
To us, that's beside, you guys were spending the beginning talking about AI and the mega trend that we see there. The second mega trend that we see is around industrial policy. And this is another similarity between both candidates, both parties, and around the world, is that there's a renewed focus on resiliency. After the pandemic, given that global conflict is at 80-year highs, companies and governments are laser focused on making sure they're secure. And security goes beyond traditional defense. It relates to supply chains, infrastructure, cybersecurity, natural resources. And that, I think, outside of the noise around the election, investors can focus on that and the companies and industries that might benefit.
Jake Manoukian, who is the JPMorgan U.S. Head of Investment Strategy. Jake, great to see you here in studio with us.
Thank you.